Good afternoon, everybody, and welcome back to Markets for Millennials for the weekly market wrap from May 16th to May 20th. And after missing a week, I apologize. Thank you for continuing to tune in to these videos. And I just continue to hope that the content that you see here is worth your time. What I have looking here, I'll explain in just a second. But there's been a lot going on in the markets the last 2 weeks. The markets are continuing to roll over, make lower lows, lower 52-week lows, and so this is something obviously that is going to continue to be the story. And the big question everybody is asking is, when will we find the bottom? Is the bottom coming soon? And we are in a time now that a lot of people aren't used to, where a lot of people have been expecting, if you go back for up until the well, actually if we could just go back, we'll go to a 3-day chart. Ever since the great financial crisis, we've been in an unprecedented time in which the Fed has been very, very supportive of the markets, and in the big picture, when we pull up the yields chart, we've been at a time for if let's see, let me take this off log scale really quick. If we go to a monthly chart of the U.S. 10-year Treasury, since the 80s, we've had just a prolonged downtrend. We've been addicted as a market to the low interest rates, and we're in a period of time now where interest rates are rising. The cost of capital is rising. The Fed is no longer supporting markets. They're rather, on the contrary, working to fight inflation. And so we're just at a very interesting time. There's been a lot happening, and so let's just jump right in. And what we're looking at here is, what I did was I took the great financial crisis period of time, the S&P market top in 2007 to the market low in 2009. And I basically just aligned the closing, aligned it to the closing high that we had in late December, early January, at the turn of 2022. And what you can actually see here is, and it's on log scale so that the chart lines up properly. And what you actually see here is, if we had a decline similar to the great financial crisis, to get to the low would take us approximately to where our March 2020 lows were. And what's really interesting is, if you kind of pull this back, if I go to a 3-day chart, maybe that'll make it a little bit easier to see. Those lows line up with this area down here, where we kind of were sideways for a couple of years, relatively speaking. And so I think that that's a very interesting place. Now, I just want to say from the get-go, I'm not predicting that we're going to get this price action. Anything is possible in the markets. The Fed is committed to curbing inflation. They're committed to, or they're even willing to allow interest rates to go beyond neutral, which I think is the biggest risk in the market to the downside. And while everyone has been freaking out about the selling so far in 2022, this is not a sell-off. It's not a crash. You can actually see, if I delete this now, you can actually see this is far more orderly. If I go down even to a daily chart, this is far more orderly a sell-off, if you want to call it that, a sell-down. The selling has been more even than it was obviously in the March crisis. And you actually can see, if you go back, where we can see it on the bar chart, the great financial crisis, you actually saw something very similar as well. From the peak in 2007, you actually see very methodical selling. And it wasn't actually until, if you think about it, it wasn't until a whole year later where you actually saw the big drops taking place. And that was obviously when when you had the Lehman moment and all that. So before you started getting those crazy sell downs, the market had already gone into, on the S&P, had already gone into bear market territory before you really started to get that steep selling. So if we go to this low right here, and I'll mark it there, that's a little under 25%, right? And then What's crazy is once you get there, once the market revisits that low and makes a new lower low, actually let me just go from here, then to get to the bottom it was another 44% down. And so what we have right now, is not at all disorderly. It's not a crash. It's not a waterfall like we could see, although it is making people uncomfortable. And by all accounts, a lot of people are making the suggestion that the worst of the selling hasn't even started yet, because a lot of the big institutions have not even really started selling to a large degree yet. So that's something to consider. But as of right now, from our wick top to the wick low from today, the S&P did hit 20% down, bear market. But if we go from just a closing basis, then it looks like we have closed just shy of a bear market. Actually, the market had a really interesting rally today. If we go to my 3-minute chart here, obviously this is the futures market, so it's open a lot more. But if we go to when the market's opened around 9:30 this morning, 6:30 Pacific time where I'm at, for the first half of the day, we dropped another 3+% on the S&P 500, and then subsequently up to the market close. Let me go to the bottom there. Subsequently to the close, we came up 2.36% total. So we retraced almost the entire drop in the second half of the trading session. And part of the reason for that is there was a lot of gamma pinning happening. And I'm actually kind of surprised given the price action. We had a big sell down on Wednesday this week. And then I was actually expecting Friday or Thursday and today to be green days, to be positive days, because we had a lot of gamma pinning or gamma trying to be rolled off. I can't remember for some reason the terms right now, but there were a lot of options because today was options expiry, and there was a lot of options at about the 4,000 level on the S&P. So I was honestly surprised that we had ended up selling down and being red yesterday, and that we didn't have a much stronger green day today, although it did look for a time that we were going to have a really strong green day before the New York session actually opened. And then it looked like we were just going to have another cascade of selling and to be below 3,900, but it turns out that we're closing just barely above 3,900. So that's really interesting. And what I'm going to be looking for as we go into the next week is, can we hold this level? You can actually see I have this green line. If I just make it brighter for you to see, this line got put here actually. I believe I established this line back in January of 2021. And then I think I moved it and then moved it back to that spot when we wicked down in March of 2021. I'd have to go back to my videos and check. But essentially that line has been there for some time, and we touched it perfectly on the 12th, and we touched it perfectly on yesterday the 19th. We wicked below it but closed above it. So I think that that's very interesting, and that just again shows you market structure of support and resistance. The horizontal levels still being very, very important even in these markets. So the question, like I said at the early on, was that everybody is wondering, is the selling over? Are we going to find a bottom soon? And right now, there's, to me, as long as the Fed is committed to fighting inflation above all else, and as long as we have not started that pivot process yet, and who knows when it will come, if it will come, then I suspect that every rally is going to get sold. And it's very true in the markets that when you are in a bear market or when you are in a downtrend, that the rips to the upside are very, very violent. And so even just in the month of May, we had a 3% move on May 4th. We had almost 2.5% move on May 13th. We had a 2% move on May 17th. So these were just to the upside, and that's just in the month of May. And then if you start from this wick top on January 4th, and you think about the up days that we've had, 2.44%, 1.83%, we have 1.6%, we have 2.24%, we have 1.81%, 2.55%, 2.17%, 2.25%, and so on. So we've been getting these really like brisk rallies to the upside as we've sold down. And so this is, in my view, it's classic of conditions in which the rallies are being, in a sense, generated, I think, in order for big players to try to sell into. I think that's what we're seeing, and I think ultimately that's why even this rally in March got faded in the end, and we obviously made lower lows. So that's what's happening on the S&P. Now I suspect that the most likely place on the S&P, and I know that a lot of people may disagree with me on this, but I suspect that the place where the S&P ends up finding its support is going to be at this green box that goes back to September and October of 2020. I think that those are the areas that are most likely to hold. I think if we lose that area, then it's going to be down into the low 3,000, like about 3,100 to 3,200 level, because that's where we had a little peak in June of 2020, and that's where our bottoms were at the end of September and October 2020. So those are the most likely places for us, in my opinion, to catch support on the way down. Those would, in my opinion, likely be areas where once we get down there, I suppose it depends on how quickly we get down there. So, for example, if this kind of mellows off and moves sideways and then slowly moves down, and it takes until late 2022, like late Q3, or maybe even into Q4 to sell down to those levels, then I think we will get down that far. If we get into something unruly where this just waterfalls down, then I suspect that the Fed will pivot and intervene quicker. And it's possible, depending on the timing, that we might get way down here before getting the pivot, or they may catch it a lot sooner. I'm not really certain, but like I said, until the Fed signals that they're going to pivot, there's no reason to expect, with the cost of capital going up and the inflation as it is, there's no reason to expect that this is going to, improve anytime soon. And again, like, you got to be really careful about shorting. A lot of people can get really greedy here and start shorting, and allocate their capital in a very very poor way. So you have to be aware. This is the prevailing trend line, and as long as we stay underneath that trend line, the trend is still down. It doesn't matter. If you think about it from where we're closing today, we could move up, 15%, 10%, 5%, and we're still technically in a downtrend. That's not going to change the overall trend. We actually have to get above this line in order to change that trend. So you have to be really careful about shorts in this case. You have to be careful, because you can get shaken out of your short position by a move to the upside, just as much as a market sell-off can hurt you to the downside. Of course, the difference is that on a short, your losses can't be capped, theoretically, because the market could just keep going up. So all that is to say, you have to be really careful here. And just because it can go down, and just because, for example, I'm expecting it to continue to go down, doesn't mean that that's what will happen. Nobody really knows. It's the markets, and anything can happen. On the NASDAQ, and I pointed this out a few weeks back in a video, I put a couple of boxes here that I thought we might bounce to, but I'm actually going to delete those because I don't think that we're going to see the bounces there. We've actually sold down below our September and October 2020 levels, And so I suspect, I mean, if you just look, there's not a whole lot between that as far as support goes, between that and, the level between, if I look at this 10,600 and 10,800, we have just kind of a small local support area, which we're currently, we wicked down to today, but that's basically it. I mean, I could totally see us breaking that next week. It'll be interesting to see now that options have expired, or the monthly options have expired. It'll be interesting to see how the positioning affects the markets going into next week. But I'm expecting that we're going to come down to this yellow box, and we could even go lower. The next logical place after that yellow box is going to be around the pre-COVID peak, so somewhere around there. And I would say the principle still applies to the NASDAQ as it does to the S&P. I suspect that we could, we have all this room to go to the downside. We could get nice big spikes on the way down, or, it could be like just super disorderly and we could just, wash down, waterfall down. But anyway, I expect those areas to be good support levels, and we'll just have to see. Obviously, the NASDAQ is down quite a bit further than the S&P. If we go from if we go from the closes, we're almost at 30% down. There are a lot of people who believe the Fed put is at 30%. So actually, if I turn my magnet on, what I'd like to do is just really briefly. So we wicked down past 30%, which is pretty incredible. And so I think that maybe I could be wrong again, because I haven't seen anything that suggests the Fed is pivoting or planning on pivoting anytime soon. But I think it's interesting that in our price action, we had wicked down so low and then we're able to recover so quickly. I think another aspect of that is that a lot of people are convinced the Fed puts at 30%. I heard that analysis a lot in the first couple months of 2022. And I think that there are going to be people who are surprised that the Fed put is not there. And again, I have to say, it's the markets and anything can happen. So that's something to think about. The Dow, I think, the Dow is following or tracking price a lot more closely to the S&P 500, interestingly enough. So let me just see our decline here on a closing basis. We're down not even 15%. So the Dow is holding up from its peak a lot better, but you have to also remember its performance up until the peak was not quite as good. And then the one thing I thought was interesting is the Russell did not make lower lows. If you actually let's go back to the S&P, and we go to May 11th and May 12th, those two particular days, we've closed lower on both of the last 3 days, or on all of the last 3 days. But on the Russell, we haven't yet. And I think that that's interesting, and that leads me to something I wanted to point out. And so I have this chart that I saved to my watch list, and this is a chart of the IWD and the IWF. And these are the Russell 1000 value, that's the IWD, and then the IWF is the Russell 1000 growth ETFs. And this is like a classic double bottom. It's really interesting. And so what you actually see here, obviously over time, the trend has been down, right? So going towards the IWF, so that's the growth aspect or the growth side of the Russell. And then what's really interesting is into 2020, you see that accelerate, right? And then we kind of peaked in September and August. And what's really interesting about that is if I go to our 10-year yield, and you actually go, it's around that same month that yields bottomed. A lot of other things were going on at that point too. That is also when gold peaked, right around that same time. So I think that that's something that is notable, what was going on around that time. So this bottomed about a month after all of those things happened, right? But you see this classic double bottom. If you actually look at the two touches, if you look at the crosshair and follow the dotted line across, you can see the touches perfectly. So in late 2020, as we approached the election, and then shortly after the election, that was that period of time where the Russell itself was outperforming, right? So that's basically during this period of time. And then that once we got to about maybe February, March, the Russell just went sideways. And then during that time, you actually, again, at that particular point, like the peak of the Russell for 2021 up until we prairie dogged it was in early March. And so you actually can see then that's where the bounce starts to roll over and we start going back more towards growth. And you might remember that it was in November where we saw Bitcoin make a new all-time high at $67,000 or something like that, or $69,000, something close to those. And then that was when you started to see the markets peaking out, and they peaked out by the end of December. And since then, value has been outperforming. And so this double bottom, I'm expecting this to come back up substantially, and so I suspect that that's why you have the Russell here. Let me go back to my bar chart, or my what is this, bars? Yeah, candle chart. I think I said bars earlier too. I think that's part of the reason why you're seeing the Russell not making lower lows, is because the deep value is outperforming. Another thing that you could look at actually is the two ETFs that track the high beta and the low volatility. So high beta assets, that's like your tech and things like that. And you can actually see what happens once we hit the bottom in March 2020. Ever since then, it's just been on a tear. High beta has been just destroying up until 2021, in the summer of 2021. And then we came off and then made a new high, barely a new high on the crosspair in November, again around the same time that Bitcoin peaked, when Bitcoin is a high beta asset too. And then ever since then, we've been rolling over, and that rolling over has actually intensified. So you can actually see it's actually rounding down. And so I think that, again, the deep value is where the opportunities are at. And I don't even mean to say that like that means that you should be buying deep value, but it is outperforming. So not to say that you can hide in deep value, but it is something that will outperform the high beta and the growth parts of the economy. Another thing I wanted to look at was the JNK, which is the High-Yield Bond ETF. And you can see we've had a bounce on the last day or two, but we continue to accelerate to the downside. What I've been doing is adding some trend lines here. And as I continue to add more trend lines, what it's supposed to signify to you is that the selling is becoming more and more pronounced. And you can see we've made it down to levels that we were at right before the bottom in March 2020, before the Fed stepped in. I think that that's something really important to look at. So now heading to, we'll look at the 10-year Treasury yield, because I wanted to point out to you, by looking at my 8-hour chart, something kind of interesting. I've had a whole bunch of different trend lines here, but right now I have the one that is the most pertinent, because even as I had a trend line that was something like that for a while, and then obviously we broke that trend line. And then I adjusted it, and then it turned into something that was more close to this, which obviously that's off a little bit, but you get the idea. And then when we broke it again and didn't make a lower or a higher high right here and right here, what I did was I drew this trend line, because we were making higher lows at least, and we were being pinched into a smaller range. And then what ended up happening was we closed below, and so we've actually made a lower low. And then the reason why I'm showing you the 8-hour chart is because when you look at it closely, you can actually see coming down, retesting, wicking above a bunch of times, but failing to stay above, and then the resumption down to the downside. And so a lot of people, I think, are watching this because this is going to be a signal as they say, well, I don't remember the saying, something about diamonds or whatever, but buying bonds again. A lot of people will start buying bonds as the safe haven asset, because obviously they haven't been safe haven for now. But if you think about what happened back in the March 2020 crisis, right? So you had the yields came crashing down as we got into the crisis, spiked, and then came back down as people were buying for safe haven. So that's something to be aware of as well. Something that I've been watching, obviously, and many people are watching for a long time, the DXY. I continue to be bullish on the DXY. A lot of people have been looking for tops. And I mean, anything is possible. But I think in our particular backdrop, there's nothing that, to me, in the macro suggests that that we're going to be peaking here. We still haven't made a lower low from May 4th. And so what I'm going to be looking for as I go to an 8-hour chart, so that this is a little bit easier to see, what I'm looking for next week is, as we've been pinned here, are we going to get this to break to the upside? I've got this kind of trend line right here, or are we going to break to the downside? And is this going to be a more prolonged, pullback on the dollar? We still have a lot of support below us. A lot of things would have to break. There would be a lot of trend lines to watch to see if the trend is indeed finally changing. But I think we have to kind of caution everybody. There's been a lot of people that have been looking for the dollar or the DXY to sell off because a lot of people believe, if the DXY goes down, then that means asset prices are going to go up. And they can, but also just keep in mind that during the March crisis, the COVID crisis, the dollar was selling off like everything else was until we had that rush to dollars, which spiked the dollar. So just because the dollar is selling, I think we have some good evidence right here to suggest that the dollar coming off doesn't guarantee that equities are going to come up as well. So just be aware of that. But my prediction, and I put this on Twitter, but I actually think probably what's going to happen is I'm going to end up deleting this dotted trend line and this dotted trend line. And I actually think that we're going to get a consolidation, something in this along here for some time. It could be a couple days, it could be a couple weeks, could be a couple months. I'm not really sure. But my reasoning for that, and I talked about this, and that's because on a longer term time frame, we got above multi-year highs. Yeah, not multi-decade, well, I guess it is multi-decade. You'd have to go back to the early 2000s for us to be higher than this, but definitely a multi-year high. And I can't imagine that after breaking a multi-year high that it's just going to race up parabolically like it was before. So that's why I'm expecting at least maybe a few more weeks of sideways price action. And I mean, it could go any which way. I mean, it could go up and then come back down. I just think it's going to be some kind of random walk sideways for at least a little while. And until the macro changes, then I suspect, like as they say, the trend is your friend and the trend is up. So I don't really know any other better way to say it than that. So be careful, and you also have to keep in mind too that the DXY is weighted more than 50% against the euro, and so that's definitely something that we have to watch. And I've been seeing a lot of people talking about this. We have kind of our multi-year low, which is at about 103. We have not broken that yet, like we have on some of the other cross pairs like the US dollar and the Japanese yen. Obviously, we got above our multi-year highs there, and we would have to go all the way back to 2002 for when we were up higher than this. So obviously, that's something to pay attention to on the euro chart. But all that to say, once again, I still expect the dollar to be bullish, and until the Fed pivots, you know, you can't just go off of your indicators, because indicators can stay, say, overbought, for example, for long periods of time. Let's take a look at gold real quick. As you can see here, gold just continues to be, depressing, I guess. And today we closed at 1846. Every rally that we get, every time gold looks promising, it gets sold off. I mean, how many times? It looks very similar, a little bit more steep, but it looks very similar to what happened after our big melt up and price explosion back in 2020, before the yields bottomed. And I think that there's very little to suggest to me that gold is going to have gold is going to change anytime soon. But I could be wrong. It's below a lot of the major levels that I've been calling out for a long time. I actually need to change the color of this one. It is above 1830. What is that? 1832. It is above that level, so that's a good. That's good. It's better than it could be. It's obviously better than being below 1800, which it wicked down below on the 16th, on Monday this week. So that's something to be happy about. But outside of that, I mean, there's this long-term trend line that I have. We did come below it. We closed above it today and yesterday, but still something that is a bit worrisome. Just not exciting at all. However, if you're a believer in the long-term prospects of gold as sound money, obviously in a time of fiat currencies, then by all means, like, this is a great opportunity to get some more. We all know that gold is severely mispriced, so you can, if you're going to hold it for the long run, for the eventual what I think is going to be an eventual repricing, then that's obviously something to count on. But it's just in the near term to medium term, it's hard to see gold really breaking out in any substantial way. And then back to crude oil. Crude oil, I mean, we popped above the level that I expected us to consolidate within, but then we came right back below it. I mean, that's not too bad considering we were on April 13th when I said that I expected gold to consolidate between about 113 and 93 for some time, before eventually making it back to new all-time, or to the all-time, or to the highs, the recent highs, I should say. I like I've been saying, I expect I expect crude oil to eventually break 130, where it wicked up to last time. And I think gold, I keep saying gold. Wow, that's really bad. I'm sorry. I'm expecting oil to be at 150 before the end of the year. And for all we know, it could happen way, way, way sooner than just the end of the year. We continue to draw down in our oil supply. The SPR continues to be dumped for political points, and I just don't think that bodes well for the oil price. And then you add into that the fact that there is no new investment happening in oil, really, to any significant degree, and the looming potential energy crisis that may come. And that's just all the ingredients for oil to continue to march higher. And then finally, Bitcoin. I know I'm a little bit over 30 minutes now. Bitcoin, I'm going to go to a 8-hour time frame. You can see that we are... a lot of people have been calling this the battle for the mid-cycle low. I think Jordan Lindsay at CTM was talking about this, or has been talking about this. We obviously have our mid-cycle low in our 1618 golden ratio level, which is actually just slightly below this gold line. And even though we did come down below it pretty severely last week, not this week, but last week, we've been tightening in this range for the last couple of days, for the last week or so, actually. And so the thing is, this type of consolidation pattern often can be a continuation pattern. So, but it doesn't have to be. But so the question is, as this continues to get squeezed into a tighter range, is this going to break down or is it going to break up? And for now, I think we can all say, like, in spite of what's been happening in the equity markets, Bitcoin has been holding up relatively well. We're actually seeing something very similar in this tight range as we did across this range in the first few months of 2022, where Bitcoin was holding above the low that it made in January while the equity markets were making lower lows. And in the same way, over the last week and a half or so, Bitcoin has stayed above its lows even as the other markets, as the equity indices were making lower lows. This actually looks a lot like the Russell chart because we've got an asset that has come down substantially but has not made a lower low in comparison to the other equity indices. So as much as, like, a lot of things have changed, like I was obviously one of those people who was saying that, I was expecting a huge parabolic peak before the end of 2021. That obviously didn't happen. I've since adapted my view to be based specifically on log Fibonacci levels. You can obviously check out my Twitter. There's also a video on the channel that talks about that thesis. But there's honestly a lot of room still. Actually, in fact, the next particular date for that thesis to play out is sometime in June. Doesn't look like that's going to happen. And then after that, it's potentially in October. And then actually the furthest out that thesis allows for is in actually March of 2023. And so when you are in a position of power, then you have the luxury to be able to wait on these things. And that's kind of where I'm at. Price would have to go substantially lower for it to get to my cost basis. And so I luckily have the ability to wait. And if you believe in the long-term viability of Bitcoin, I feel like I've said this a lot, then it really shouldn't matter because historically nobody that's held Bitcoin for at least 4 years has ever lost money. Eventually there will be another halving, and if you believe in Bitcoin, then you probably also believe that its price is going to be higher in, say, 10 years than it is today. So that's kind of where things are at. But there are two possible locations, and I guess actually I should explain this before I jump off for today. There are two possible places that I can see for price to fall down to, and they actually are related to, let me go to my log chart for this. They're actually related to wow. Oh, I remember what I was saying. I got asked on Twitter, sorry about that. The two places I'm watching as to be supports is this level, which we had a slight consolidation at the end of December 2020, and then obviously where the old all-time high was between 19,000 and 20,000. But a lot of people have been asking me, because I've talked about having limit orders placed. So I had limit orders placed at the mid-cycle low. I still have limit orders placed at the old all-time high. And I also have limit orders placed at the peak of the 2019 peak, the rise that we had there, which is coming in just around 13,000 to 14,000. So I have limit orders in there too, just so you guys know where I'm at. But obviously I believe in the long-term use case of Bitcoin, especially as a sound money. And so I think it's worthwhile, but obviously I can afford to wait and see. So anyway, I hope this video is helpful. I know it's on the long side, but I did miss some time, and so I hope that this was helpful. I hope that this allows you to see what I'm seeing in the markets and what I am looking for and what I'm watching as we go forward into the next week. So thanks again for watching. I hope you guys have a great weekend, and I'll see you next time.